Hi, I'm Rob Van Raphorst. Welcome to MBA Now. Today we're joined by Laurie Goodman, who's the co-director of the Housing Finance Policy Center at the Urban Institute. Laurie will be one of our featured speakers at this year's Risk Management, Quality Assurance, and Fraud Prevention Forum in Miami, Florida on September 24th. Laurie, thanks for being here.
Thanks very much for having me here, Rob.
So MBA publishes our own Mortgage Credit Availability Index that talks about the supply side of credit. Now, I know you guys have your own index. What is it showing about credit?
Our Housing Credit Availability Index is showing that credit availability is very, very tight. Essentially, what we do is we look at the probability of default of mortgages originated in any given origination quarter. And what it shows is the market now is taking less than half the credit risk it was taking in 2001, a period of reasonable credit standards, and less than a third of the credit risk that it was taking in late 2006, a period where we all agree credit standards were too lax.
So since the election, rates have gone up and we've moved more to a purchase market, what does that mean for credit?
Credit availability is apt to loosen a bit. Usually during in a purchase market, lenders work a little bit harder with that marginal borrower because they don't have a huge amount of refi volume coming in and they've got the time to do it, and they are looking for origination volume. That said, higher rates tend to stress affordability a little bit, so you also have fewer people qualifying for that reason. But at the margin, we do expect to see a relaxation of credit.
Yeah, and right now there's a big focus on the first-time home buyer. Can you talk a little bit about the first-time home buyer and what happened during the Great Recession?
Sure. There's this myth that the Great Recession was caused in large part because lending standards were stretched to accommodate that first-time home buyer, and we let in borrowers with more risky characteristics than otherwise would have been the case. In point of fact, what our research has shown is two things. Number one, purchase borrowers performed far better than refi borrowers, both during the Great Recession and also before. That is, the more risky loans were the refinance loans, and in fact, during the Great Recession, 84% of refi activity was actually cash-out refi activity. And second, our Housing Credit Availability Index actually shows that borrowers were no more risky during the 2006-2007 period than they were in 2001. The big increase in risk between 2001 and 2006 was actually due to product risks. That is, the introduction of risky products, including interest-only mortgages, 40-year mortgages, negative amortization mortgages, mortgages with less than 5 years to the reset.
Yeah, it's all really interesting. We really appreciate you stopping by and talking about it. We look forward to hearing you speak at our RMQA forum coming up.
Thank you very much, and thanks for having me here today.
Be sure to follow us on Twitter at MBA Mortgage and like Mortgage Bankers Association on Facebook and Instagram.